So give us a sense, where should we put our money, given all this indecision, all this waiting for things that aren't quite happening yet?
Well, we're definitely going to see some short-term economic turbulence with these cases rising and the lack of stimulus, but we're optimistic on 2021 because the vaccine is right around the corner. We should get stimulus in the first quarter, and the key for the markets to continue to work in 2021 is going to be passing that baton from valuation-driven markets to earnings-driven markets. We do think that stimulus, the consumer coming back to normal, and also operating leverage for companies that have been cutting costs through the pandemic are going to drive S&P 500 earnings faster than people expect. So that leads us to liking areas such as small caps. Outside of the U.S., we like emerging markets.
So if we're going to get back to earnings and away from valuations, as you just said, does that also mean we're going to get a little bit away from the growth and more into the value? Some people are talking about that rotation as well.
Yeah, we see more of a stock picker's market, so less correlations between companies. So this isn't going to be all about just own the FANG stocks like you could have done for the last decade. However, we do still think technology stocks have those margins and strong free cash flow to continue to work. But value stocks are interesting. Look at financials where there's upside to earnings. We see yields going up a little bit on the 10-year. That's positive for financials, and they're very cheap. And small caps also, they have that operating leverage to a fast growing economy. And also as interest rates start to slowly increase, it's good for small caps. So these are areas where we think you can broaden out and now just not worry about owning just 5 stocks in the FANG space, but a lot more than that.
Sarah, what about the so-called reflation trade? Do you buy it?
Moderately. So some reflation is good for the economy and stock market. Too much inflation could lead to overheating. We think there will be some inflation as we go back to normal, but there's a lot of headwinds still for inflation, including productivity, offshore manufacturing. That's going to keep the lid on pricing. And the most important aspect is wage inflation. And we're not seeing that yet because the employment market is not tight. So without wage inflation, we're not worried about too much inflation causing the economy to overheat.
So, Sarah, you're saying that you're really focused going into 2021 on earnings more than valuation, but some of that valuation has come surely from the fact that we have essentially zero interest rates. We've got the Fed meeting next week. Is anything the Fed going to say or do going to affect equities?
We doubt it. We think the Fed will stay on message, which will be very accommodative, do what's necessary to get us to where we're back to more of a normal economy. And that should be good news. But valuations are getting pretty full, and we do need that earnings growth to kick in across the board and drive us to strong returns in 2021. And as I mentioned earlier, there's a very good chance of that. Our forecast is that earnings consensus actually for the S&P 500 is probably too low. If you look at 2021 earnings pre the pandemic, the S&P was set to earn 194 in 2021. We're at about 170 for next year, and we see upside to that 170.
So you said you think it's a stock picker's market we're coming into here. You can't just sort of ride the beta up. Where do you look for alpha? How do you sort of find it?
Well, for example, we talked about financials. So look for quality companies like Bank of America, which actually was a conservative lender throughout this crisis. We also talked about non-U.S. markets. You get more bang for your buck from emerging markets in areas such as Mexico and Brazil, which really need the vaccine for them to come back to normal. And there's great companies over there like Arcos Dorados, which trades in the U.S. This is the Golden Arches of Latin America. It's the largest McDonald's franchisee, great brand name, also leveraged to the consumer. And then we like areas such as China and Thailand, airports of Thailand, very leveraged to tourism. And when we all start traveling again, I think Thailand's going to be a top choice for a destination.
So follow up on that for a second. You mentioned Latin America, but then Asia. Asia seems to have done a bit better in dealing with COVID-19. Is that particular place we should be looking for investment?
China is the biggest piece of the emerging markets benchmark. And while it's done well and grown quite well, it has a lot of liquidity and stimulus still in place. And we actually think China does not look expensive yet. So Chinese companies, China A-share companies, we particularly like Macau gaming stocks. All of those to us still look attractive. It's not an expensive region, even though it's deservedly done well in 2020.
Does that get us into politics at all as we see the Trump administration on the way out really trying to take a ding at China companies listed over here?
I think that with the administration change, it actually becomes easier for some of these emerging market countries, such as China and Mexico. And that's part of our thesis for why we like those two regions in 2021.